In this video, we are going to look at what we call tax incidence, or who pays what proportion of a tax when a tax is imposed. So let's look at a fictional market here. Let's assume that this is a market for apples, in our fictional town or village. Okay, so in this market, the equilibrium price for apples is $1, and at this price, 300 quantities or 300 units of apples is sold. So let's say a 50-cent tax is imposed in this market. So there is a tax of 50 cent on a unit of apple. Okay, so 50 cent on a unit of apple. Okay, so how do we represent it first of all on this in this market? So anytime that there is a tax imposed, the way you show it on the market is shift the supply curve upwards by the exact amount of the tax. Okay, so I'll shift the supply curve back, and this will be your new supply curve plus the amount of the tax. Okay, if I say shifted by the exact amount of the tax, that means that this gap here should just be the tax amount. Okay, and we know the tax is what? The tax is 50 cents. All right, so we know that this will be our new equilibrium. Let's call it point D. The new equilibrium lies to the left of this one, meaning the equilibrium quantity will fall. Let's say it falls to 250. We know that the difference between, so the gap between this point and that point should just be the amount of the tax. Okay, so this gap right here is the amount of the tax, because that is the gap between your new supply curve and the old one. Okay, so previously equilibrium quantity was $1, so I'm going to assume, looking at the distance between here and there, that the top one is a smaller distance. So let's say price goes up by $1.20. Uh, and if the distance between this point and that point right there, which is the gap between the two supply curves, should be 50 cent. If this is 1.2, then this point needs to be 0.7 or 70 cents. Okay, so this should be 70 cents. So that 1.2 or $1.20 minus 70 cents should give you 50 cents, which is the gap or the shift in the supply curve. Okay, so in this case, previously the equilibrium quantity was $1. A tax of 50 cents was imposed on this market. Now buyers are paying $1.20 and sellers are receiving 70 cents. Okay, and how much of the tax of 50 cents is put on buyers? Buyers only pay. Buyers are paying what? 20 cents of the tax. Okay, they are paying 20 cents, which is the difference between what they were paying earlier and what they are paying now. Okay, and sellers are bearing what? Previously, sellers were receiving $1, now they are getting 70, so sellers are bearing 30 cents of the tax, or they are paying 30 cents. So this is how the tax is split. This is what we call tax incidence, which is how a tax is split between buyers and sellers when a tax is imposed. In this example we have here, buyers bear 20 cents of the 50-cent tax, and then sellers bear 30. Okay, now if you want to know what is the total revenue that is made from this tax, that will be the tax amount, which is 50 cents, right? The new equilibrium 250 is sold. So the tax revenue here will be your 50 cent times how much quantity is sold at the new equilibrium, which is 250. So this will be 125. Okay, so that will be your tax revenue. It's 125. So this is how you determine tax incidence. Thank you for watching. If you like this video, please comment, like, and subscribe.